In this 2-minute trading tip, we're to cover 4 ways that you can set targets for your trades. Obviously, there are numerous ways that you can go about setting targets, but these 4 can serve as a solid foundation for any trader. The first and most simple way is going to be setting targets based on our stop loss size. So if we've come to a conclusion about where we need to set our stop in the markets, we can then use the size of our stop to achieve a certain R factor. For example, if I enter a trade and my stop loss is 5 points away and I want to achieve a 2-to-1 R factor, I can exit the trade at a 10-point profit to achieve this. The next method would take it a step further and use a target based on rotation sizes for our specific market. So at Convergent, we provide weekly updates to the rotation sizes for several popular futures markets, and this information shows us how volatile this particular product is from week to week, month to month. So we can use this to set appropriate stops and targets based on how much this market is moving on average. The next method is to utilize key market levels. So during our pre-market, while we were preparing to trade, we identified particular levels that we thought would be inflection points in the market. And so we can target those zones when we enter a trade. At Convergent, we like to call our levels stock zones, and this is also something that we provide to our members as well. And the fourth method for exiting a trade or setting a target is to use targets based on price action or order flow. So this would be not really setting a target at all, but using the price action to determine the end of a trend on our particular time frame. So which of these strategies for setting targets or exit points is the best? And the truth is, there's really not a best method. Each has their pros and cons. So many members at Convergent utilize a tiered risk management system. For example, they might take a first scale out at a 1-to-1 ratio with their stop loss. So perhaps they're taking their first scale out at 1R. Their second scale out could be at 1 normal rotation. So they're using the rotation statistics to determine a likely distance that price will travel and then exiting at that location. And then they may be taking a third scale out at a larger key level of the day, a key target that they've identified in their pre-market preparation. And as an advanced technique, some traders are using order flow or price action to determine if they should be exiting yet or not. So if the market is approaching a key level and then just slices right through it and continues, you may not necessarily want to exit right at that moment. You may want to wait until the price action confirms that the momentum is starting to fizzle out. Conversely, many new traders often over-depend on their analysis of order flow or price action, and this causes them to make frequent mistakes by exiting trades too early because they believe that the trade is coming to an end. There's many profitable approaches and configurations for trade management. The key is identifying a sensible solution for your trade type and your time frame, and then capitalizing on as much R factor as you can achieve. For many traders, developing their system for identifying targets is not the difficult part. It's the adherence to a consistent risk management system. And so if you're struggling to consistently approach markets in the same way every time that you trade, we'd recommend focusing on your mental game, and you can do so by checking out our webinar, 3 Keys for Developing a Winning Day Trading Mindset with Jared Tendler.